If the institutions are really coming, where is the proof? Where is the actual on-the-record confirmation that the biggest names in global finance are no longer experimenting, no longer studying, no longer waiting, but actively moving real money through this new infrastructure right now? I want you to listen very carefully, because what I am about to walk you through is not being explained to retail investors the way it should be. While the crowd was busy staring at red candles and arguing about short-term price action on Twitter, three of the most conservative, most scrutinized, most legally cautious financial institutions on the planet just quietly admitted something that changes the entire conversation. Visa confirmed that its stablecoin settlement platform is now processing more than $1 billion in monthly volume. JP Morgan is doing the same.
MasterCard is doing the same. And the CEO of Coinbase just walked into Washington and told lawmakers on the record that more than $30 trillion is sitting on the sidelines, ready to enter this exact infrastructure the moment the Clarity Act passes. 30 trillion. Not 30 billion. 30 trillion. That is roughly the size of the entire United States economy, positioned and waiting for a single piece of legislation that the White House has now openly stated they want signed before July 4th. The world missed the signal. Let me pull back the curtain and show you why this is the moment the thesis you have been holding finally stopped being a theory and became an active, live, unfolding reality. Make sure to like and subscribe and drop a comment below with your opinion on XRP, and watch until the end, because the final minutes reveal why July 13th could change everything. Welcome back to the channel. In a market fueled by emotion, headlines, and noise, we operate on data, structure, and composure. Today, we are decoding the convergence of three independent institutional commitments: one piece of legislation, one macro liquidity cycle, and one approaching access event in Asia that together describe a picture most retail investors are not yet seeing clearly. Before we go under the surface, none of this is financial advice. This is structural analysis. Let's jump in. Let's start with the hard truth. 90% of people watching the crypto space right now are staring at the wrong thing. They are watching candles. They are watching influencer takes. They are watching the daily noise of price action, while the actual structural shift, the one that determines where this market is going over the next decade, is happening in boardrooms and settlement layers they will never see. If you want to understand why what Visa just confirmed is so significant, you need to understand one thing first. Visa is not a crypto company. Visa is one of the most conservative, most regulated, most reputation-sensitive financial institutions on the planet. They have shareholders who scrutinize every quarterly report. They have regulators in every major jurisdiction watching every product decision they make. They have spent decades building a brand that they are simply not willing to risk on an unproven idea. So when Visa walks out publicly and confirms that its stablecoin settlement infrastructure is now processing over $1 billion in monthly volume, understand what that actually means. They are not testing. They are not piloting. They are not exploring. They have already run the numbers. They have already stress-tested the technology. They have already passed it through legal, compliance, and risk. And they have determined that the commercial case is strong enough to commit publicly to the world. Here is the part the retail crowd ignores. Visa operates a settlement layer that allows banks, payment processors, and card programs to settle transactions using digital currencies, including stablecoins. A stablecoin is a digital dollar. One token equals $1. It is not designed for speculation. It is designed for speed, finality, and traceability. RLUSD, the dollar-backed stablecoin built on the XRP ledger, runs on this exact category of infrastructure. And here is the structural genius of why this works for Visa commercially. Payment providers at this scale hold enormous reserves. When those reserves sit in instruments like treasury bills, they earn yield. The shift to stablecoin infrastructure does not eliminate that yield advantage. It complements it. Visa holds the underlying reserves, earns the interest, and simultaneously runs a faster, cheaper, more efficient payment rail on top. That is not a trade-off. That is a structural upgrade to an already wildly profitable business model. This is why Visa moved. This is why MasterCard moved. This is why JP Morgan moved. Not because of hype, because the math finally worked. Now, let's do the math that the retail crowd consistently ignores. The global stablecoin market is now processing tens of trillions of dollars in annual transaction volume. Let that sit for a moment. The raw throughput of stablecoin infrastructure has already exceeded what traditional card rails move on a global basis, not projected to exceed, already exceeding. Now, to be intellectually honest, some of that raw volume includes automated activity, what the industry calls wash trading from bots. But when you filter that out and look only at adjusted, verified institutional payment utility, the picture remains structurally undeniable. Real volume, real demand, real growth, month after month. Here is the math that matters. Cross-border payments globally move approximately $150 trillion annually. Foreign exchange markets move $7.5 trillion every single day. Nostro and Vostro accounts, the dormant liquidity sitting in correspondent banking, lock up roughly $27 trillion globally at any given moment. That is $27 trillion of trapped capital that exists for one reason only, because the legacy settlement system is too slow and too fragmented to operate without it. Now, layer in the Coinbase CEO's statement. Over $30 trillion in the United States financial system is positioned to enter this infrastructure the moment regulatory clarity arrives. That number is not speculation. That is the size of the addressable pool that institutions have already told Washington they are prepared to deploy. Think about that math. Even if digital asset infrastructure captures just 1% of the cross-border payment market, that is $1.5 trillion flowing through these rails annually. Capture 5% of Forex daily volume, and you are looking at $375 billion per day moving through this new system. These are not moonboy fantasies. These are the rational mathematical outcomes of a structural migration that is already underway. If you have a problem with these numbers, you do not have a problem with me. You have a problem with the size of the global financial system and the speed at which it is being rewired. Here is the part of the story that received the least coverage and is by far the most significant. Visa was not alone. MasterCard and JP Morgan are also processing stablecoin transactions at scale. It was mentioned briefly in the coverage and the conversation moved on. It should not have. Ask yourself this brutal question. Does a company like JP Morgan, an institution that has processed trillions of dollars in transactions for over a century, commit publicly to a new settlement technology without absolute legal certainty and an ironclad commercial case? Absolutely not. They do not gamble. They position. Does MasterCard, an institution whose entire valuation rests on the trust of its payment network, publicly commit to stablecoin processing for entertainment? Absolutely not. They commit because their internal analysis has concluded that this is where the puck is going. When Visa, MasterCard, and JP Morgan, independently, through different boards, different risk teams, different legal frameworks, different corporate cultures, all arrive at the same conclusion at the same time. That is not coincidence. That is convergence. That is three separate rigorous institutional analyses all landing on the same structural truth. And this is not retail FOMO. This is not influencer hype. This is calculated quiet positioning by the exact institutions that the most skeptical voices in your life have trusted with their savings for decades. These are the firms your accountant respects. These are the firms your financial advisor recommends. These are the firms that move slowly, carefully, and almost never publicly until they are absolutely certain. They are now publicly certain. Meanwhile, What is the retail crowd doing? Complaining in comment sections, panic selling on red days, demanding to know why the price has not gone parabolic yet. The institutions are signing NDAs, building infrastructure, processing billions in monthly volume, and positioning silently. The asymmetry between what retail is doing and what the smart money is doing has rarely been this wide. Now let's talk about the catalyst that ties this entire picture together. The Clarity Act. In plain language, the Clarity Act is the piece of United States legislation that would finally define the rules of the road for digital assets. It would specify which assets fall under which regulatory category. It would clarify which government body has oversight authority. And it would define what legal obligations institutions face when operating in this space. This is the single piece of legislation that the largest institutional players in the world have been waiting on. The legal ambiguity that gave the most cautious firms a reason to stay on the sidelines. That ambiguity ends the day this bill is signed. The White House has now stated openly that they want the Clarity Act passed before July 4th. That is not a passing comment from a junior staffer. That is a publicly stated executive-level priority with a specific deadline attached. When the President of the United States and the senior leadership of the relevant agencies treat a piece of crypto legislation as a near-term must-pass item, the institutions watching from the sidelines take note. The Coinbase CEO has confirmed that Washington is preparing to accelerate digital asset rulemaking specifically to unlock access to the $30 trillion pool of U.S. financial capital. Tokenization, the process of converting traditional financial assets into digital tokens that can be transferred and settled on blockchain infrastructure, is the mechanism. The Clarity Act is the green light. When the Clarity Act arrives, the wait-and-see money becomes the all-in money. The risk premium that has been suppressing institutional commitment vanishes overnight. The $30 trillion Coinbase referenced does not move all at once, but the conditions for it to begin moving will exist for the first time in the history of this asset class. Institutional adoption is only one side of the picture. The other side is capital availability, and that side is now changing rapidly. China recently injected 304 billion yuan into its financial markets in a single week. Why? Because China's economy was sliding toward a deflationary state, a condition where prices fall, spending slows, and the economy gets trapped in a downward cycle. The government's response was direct and aggressive. Inject capital, increase money supply, restart momentum. 304 billion yuan in a single week is not a minor adjustment. That is a deliberate large-scale capital injection. And China is not operating alone. Global M2, the broadest measure of global money supply, has been expanding consistently since March. Multiple major economies are simultaneously increasing the circulating currency in their systems. More money in the system always finds its way, eventually, into investment markets. Here is the historical relationship that matters. Rising global liquidity correlates with price movement in digital assets. But the relationship is not instant. Capital does not teleport. The documented historical lag between new liquidity entering the global financial system and that capital materially affecting digital asset prices has consistently been 3 to 4 months. The capital moves through traditional asset classes first, then gradually migrates toward higher risk, higher return investments. If global M2 expansion began in March, a 3 to 4 month lag places the window of potential impact somewhere in the June through September window. The data points in that direction. Now layer in the cycle structure. October of last year was the start of the current bear market for XRP and the broader crypto space. That means October of this year marks the 12-month point. This is not arbitrary. 2 of the 3 most recent bear cycles in this space lasted approximately 12 months. If the current cycle follows the same historical pattern, that 12-month mark coincides with the approaching transition. When you overlay the liquidity timeline and the cycle timeline, they converge on the same general window. In the interest of complete intellectual honesty, there are short-term headwinds. Geopolitical tensions, particularly in the Middle East, are pressuring risk assets globally. These are not XRP-specific issues. These are macro uncertainties that push capital toward safety in the short term. That is a variable to monitor, not a reason to revise the structural thesis. We are moving from an era of abundance to an era of scarcity. Understand what that actually means. Right now, today, the door is still open. You can still position. The price still allows accumulation of meaningful amounts. The infrastructure is being built, the legislation is being drafted, the capital is being staged, but the public has not yet connected the dots. That window is exactly the kind of window that closes without warning. Japan is preparing to approve its first XRP exchange-traded fund in the coming years. An ETF is a financial product that trades on a traditional stock exchange and gives investors exposure to an underlying asset without requiring them to manage a wallet, an exchange account, or any of the operational friction that has kept conservative capital on the sidelines. For millions of investors in Japan and across Asia, an ETF is the door they have been waiting for. SBI Holdings, one of Japan's most prominent financial institutions, is already deeply integrated with XRP infrastructure. A recent XRP-focused event in Japan drew record-breaking attendance. These were not casual onlookers. These were people who showed up specifically because they intend to allocate as soon as the structured pathway becomes available. The demand does not need to be manufactured. It needs a door. That same pattern is forming across Europe and the rest of Asia. Economies representing tens of trillions of dollars in combined investable capital are still waiting for formal regulated investment vehicles. Each new market that opens a regulated XRP access point releases another wave of long-term institutional and retirement capital. Capital that moves slowly, but moves in massive sustained volumes once it begins. Once a token enters a multi-signature institutional custody vault, it does not come back to the market for a 10% profit. It is gone. That is the structural reality of institutional accumulation. The liquid float available for the next wave of retail interest gets smaller, not larger, with every passing quarter. The institutions have spent years quietly accumulating while the retail crowd has been shaken out, frustrated, and confused. That was not accidental. That was the system working exactly the way it was designed to work. The exit liquidity of the impatient funds, the entry of the informed. I know it has been tough. I know watching the red candles week after week tests every ounce of conviction you have built. I know the headlines have been designed to make you question whether you are reading the situation correctly. As an analyst, my job is to distinguish between noise and signal. And right now, the signal is louder than it has been in years. While the masses are focused on short-term price action and Middle East headlines, the smart money is processing $1 billion a month in stablecoin volume, lobbying for the Clarity Act, preparing Japanese ETF approvals, and positioning across multiple continents. Being early feels exactly like being wrong, right up until the moment the structure catches up and reality reprices. The question is not whether the price will recover. The question is who is still holding their position when the new floor is established and the new cycle begins. For someone in their 50s or 60s, someone who has built a financial position over decades and intends to preserve it and pass it on, the question is not what happens next week. The question is whether the thesis still has the foundation you originally believed in. The thesis is not broken. It is being validated week by week by the most credible institutions on the planet. Make sure to like and subscribe, and then drop a comment below with your opinion on XRP. And watch until the end, because the final minutes reveal why July 13th could change everything. Step back and look at the whole picture. Visa, MasterCard, and JP Morgan independently committed to stablecoin infrastructure. The Clarity Act is moving with executive-level urgency and a stated July deadline. $30 trillion in U.S. capital is staged and waiting. Global M2 has been expanding since March. China injected 304 billion yuan in a single week. The bear cycle is approaching its historical 12-month transition point. Japan's ETF is approaching. SBI Holdings is integrated. Asian and European capital pools are positioned and waiting for the door to open. Price is a distraction. Structure is the reality. One is a bubble of emotion. The other is a bridge being built by the institutions that move trillions. The question is, are you watching the noise or are you watching the structure? Before I sign off, I want to ask you something genuine. Drop a yes or no in the comments. Did you know before this video that Visa, MasterCard, and JP Morgan were all already processing stablecoin transactions at this scale right now? I want to see how many people in this community are actually tracking the institutional layer of this story. If this kind of deep structural analysis is what you came here for, hit the like button, subscribe, and share this with someone in your circle who is only following surface-level crypto coverage and has no idea what is happening at the institutional level globally. In a market fueled by emotion and noise, we thrive on data and composure. Haste leads to loss. Calm analysis leads to victory. Stay patient, stay rational, stay positioned. I am the calm analyst. And as we always do, we do not wait for the future. We plan for it. I will see you in the next one.